What's up, Motivation Nation? It's your boy, Will Motivation, back with another classroom session about using cash versus financing your deals. So, if you're thinking about purchasing real estate and you've got, cash saved up enough in the rare case where you have enough cash to actually buy a property outright and have enough left over to handle the rehab, um, I want to talk about that scenario versus financing your deals and using the bank's money or using money from another source where you have to pay interest and that kind of thing. So I want to talk about the pros and cons of each, and we'll start with talking about the pros of using your own cash. Now, if you are not in a position where you don't yet have cash saved up, I still want you to listen to this lesson so that you understand some of the principles and some of the differences of using cash versus, financing your deal. Because one day, if you start doing flips, for example, and you start with little, just enough to finance your first deal, you do a flip, but let's say you make 50,000 in profit, or let's say you do a really good flip, you make 100,000 in profit, or maybe and then you do it again, and the next time you make another 100,000. You got 200,000 sitting in the bank. You look over the landscape of opportunities, and with that 200,000, you are ready to buy a property potentially with cash. Or you could keep that 200,000 in the bank, and you can finance the deal, and you're just paying, your 20% down, for example, to purchase a property. So you still have some money left over in the bank. And let's just talk about that because I want you to think as if you're going to be successful, and that will actually help you to be successful. And this scenario one day could be your actual scenario if it's not already. All right, so let's get right into it. Using cash. What are the pros and cons of using cash to finance your deals? So if you use cash to purchase real estate, one of the pros is if it's a rental property, you have a higher monthly return on investment. So basically, after you pay your expenses, if you use cash, you don't have to pay a mortgage. So instead of that money going towards a mortgage and mortgage interest, all of that money actually goes into your bank account, and then you only have to pay what's left over, which might be taxes and insurance, and whatever repairs or expenses that might come up. But usually it's taxes, insurance, and maybe HOA, right? Homeowners Association. So your monthly return from your rental properties when you use cash is higher, and sometimes it can be a lot higher, anywhere from, in my case, my average mortgage is probably $500 to $600 a month. So if I had that home paid off, that's an extra $500 to $600 going in my pocket. And in some cases, I have mortgages that are much higher, so they might be $1,200 a month for a property, and I pay that property off, and then that 1,200 is actually going into my bank account every month. So that's one pro, right? And if you're doing a flip, the second point is that a flip can be more profitable because you don't have to pay interest to the bank, and you don't have to pay, their documentation fees, or any fees that a bank or a lender might charge you. So it might be a bank or it might be a hard money lender, and of course they want interest, right? They want to get a return on their investment, lending that money to you, right? So if you don't use a bank, then when you go to sell your property, you won't have to pay, that lion's share of the money back to the bank for that flip, and all of that money comes back to you. And in the meantime, while you're rehabbing the flip, normally if you got a mortgage, you're paying that mortgage every month. Let's say it takes you 3 to 5 months to flip a property, you're going to pay 3 to 5 months of interest, which can be a lot sometimes. It can be in the hundreds or thousands of dollars, in interest, especially if you're using a hard money lender. It's going to be a lot more than that. Okay, so and just to be straight up with you, if I had to choose between using a hard money lender and using my own cash, I would use my own cash every time versus a hard money lender. Now, me personally, on the flip side, using my own cash versus using the bank's money, most of the time I'll use the bank's money because the interest, in my opinion, is low enough. If I do the flip fast enough, I can keep my cash on hand for whatever emergencies might pop up for the rehab and other opportunities that might pop up, and then use the bank's money, right, and just pay them the interest. But not all the time, because I actually have a lot of my properties paid off, and basically they're paid off with cash. And I had the option to keep the mortgages on those properties. So it just depends on your situation, right? But so let's continue to talk about it. So another pro of using cash is sometimes it can be less stressful because you don't have that monthly payment coming in, and usually your taxes are only paid out every 6 months, at least in Ohio where I am, your property taxes. Sometimes you can pay them out monthly, but it's usually 6 months. So if you paid in cash to do like a flip, for example, it could be less stressful because you don't have to pay a reoccurring bill every month. That could be pretty large, because you already paid cash. So you're not stressed out about those bills coming in every month, right? But, and I put in parentheses, possibly less stressful because having more of your own money sitting in the bank or more of the cash in the bank can sometimes relieve the stress of having to make that payment because you got your cash sitting there in the bank, all right? So another pro of using cash is, and this is a big one, is it can be these two last 2 points. One of them is you can close faster when you pay in cash, and the other one is you have more negotiating power with a seller of a property. Like let's say you find a property and you want to buy that property, and but it's a little bit competitive, and let's say there's multiple offers. If you have a cash offer, you can negotiate because the seller knows if you got the cash there, then usually the deal won't fall through for finance reasons. But if they choose another buyer and they're financing the property, sometimes that financing can either fall through or it can slow things down. And so that becomes a risk for the seller, especially if they're trying to hurry up and get out of the property. So it becomes a negotiating piece if you do have cash to buy a property with cash because you can make a cash offer so you don't need financing. You can close quicker. And the reason why you can close, let me explain why you can close quicker when you have cash. The reason why, when you're buying a property and you get a loan, usually your loan has to be approved and has to go through an approval process. You might have to submit an application for that mortgage and that loan with the bank, and that takes time, right? And also, when you go to the actual closing, um, the title company will be there, and then they don't have to negotiate a time for the banker to show up, and then it's just you, the title company, and then the seller. So you can actually close a lot faster when you have cash. And when I say faster, what does that really translate to? It can be actually, rather than closing in weeks and maybe more than a month, closing with cash can be in days sometimes, if not, a week or a little longer than a week. Just depends on how much time the title company needs. But you don't have to wait for a bank. So those are the pros of using cash, in my opinion. And then sometimes you just get a peace of mind if you're that kind of investor and you don't like paying interest. That's the big thing. You're not paying interest. You're not sharing your profits with a bank or a lender. Instead, you're getting all of the profits going back into your pocket. But there are some cons. And so, one of the cons is what I like to consider being closer to being cash strapped, potentially, right? So let's say you've got $200,000 in the bank, you find a property for 150,000, you buy it with cash, you got 50,000 left, your rehab takes up 30,000, and you're sweating bullets because you've only got $20,000 left, and originally you had 200,000, right? So if the closing or the sale of that flip takes a long time, or if you're renting it and you just put all your money there into that house, if anything goes wrong, it's going to eat up part of that 20,000 you have left over. So it's just an uncomfortable feeling of being closer to being strapped for cash for a property. So that's why I recommend people, if they can, instead of being cash strapped or using all of your money to buy a property, create relationships with banks so that you can pay low interest rates and do what you have to do. And then when you've got cash saved up and you want to pay off the mortgages, you have that option. But it's totally up to you. Now, another con with using cash is you can buy and control less real estate than if you finance. So what do I mean by that? Let's say you had that same $200,000. Let's say there's a couple of, let's say there's a market where there's a bunch of houses for around $100,000. So, and you got 200. Now you can buy two of those houses, right? Two $100,000 houses. But if you use financing and you only had to use 20% of your money, how many houses could you buy? You could buy 10 of them. You could buy 10 because they're all $100,000 and you only need 20% down if you use a traditional bank to get a mortgage on those houses. You could potentially tie up 10 pieces of real estate as opposed to just two. So what's the benefit of that? Okay, so you might have your hands full, but once you own that property and you've got that mortgage on that property, even though you have a mortgage and you don't own it free and clear without, the bank having a piece of interest in that property, you control it so that you could actually decide to rent it out and make money off of it. You could decide to flip it and then, and rehab it and then sell it and then flip it for a profit. Or you could even just turn around and let's say you got found all of these killer properties for 100,000 each, and then over time, they're worth 130,000 without even a rehab. So, but you're in control. So you will be able to control more property if you were to use banking to get mortgages and then spread that 200,000 over as many properties as you can get because you got control. And if they're good deals, they're good deals. Like one of the things in my real estate experience that I regret is that I didn't have the banking relationships earlier and I didn't understand the relationships and I didn't have anybody telling me what I'm telling you guys to say, yo, this market is good. I knew the market was good, but I was using cash to buy my first properties instead of getting the bank to go in with me, and then I could have bought double the number of properties that I bought, or close to it. So that was me having to learn, right? I didn't have the knowledge that I'm trying to share with you guys, but that's one con of using cash to buy a property outright. If you finance, you can buy more property. And another con is there's maybe more stress if all your cash is tied up. So let's say you go from having $200,000 in the bank to having 20,000 because you bought a $150,000 property, you rehabbed it for 20 grand, and now you only got, 20 or $30,000 left. You might be stressed out about that, especially if that property doesn't sell right away. And even if it does sell right away and go into contract right away, you still got to wait for the money to come back. So sometimes that can be stressful, right? Especially if you don't have a source of income that's, constantly coming in. So you got to be careful about that. And then another con is you just have less options when all your cash is used up or tied up. You can't, it might be investing in real estate, or it could be doing many other things like investing in business or investing in learning and knowledge and investing in yourself. You just have less options when your cash is tied up. All right, so those are the pros and cons of using your cash. Now, what are the pros and cons of using bank financing? So, if you use bank financing, one of the first pros is it will allow you to leverage your cash to do more deals. You can control more property to flip or rent out. Maybe it's less stressful than using your own money because you'll have more of your own money in the bank, right? If you had that example of having enough to buy property outright with cash, but you decide to finance it, and you only put 20% down instead of 100%, then you'll have more of your own cash in the bank to do the rehab, to buy another property, or whatever you need to do, right? So that's those are the main pros, and they kind of go hand in hand with the explanations I gave you around the cons of using cash. But those on the flip side, those are the pros of using financing. Some of the cons of using financing from working with banks or lenders is that your credit could fluctuate, right? So every time you get a new property, you get a hit on your credit, and every time you get a hit on your credit score can go down. That actually has happened to me. And then also your finance, depending on what kind of loan you have, the finance rates can go up and down. Like I just received I have a variable rate on some of my loans, right? Because they're short term. They're like 10-year notes, and mortgages on rental properties that I have. And it went from 5% interest to 7% interest just recently, and it adjusted. And so I'm paying 7% interest now versus 5%. So the bank is getting more money, and that's a con of using a bank if you hold on to that loan for long enough for it to adjust, or if you get an adjustable rate loan. Now, if you get a fixed rate loan, you might initially pay a higher interest rate, but you don't have to worry about that fluctuation. Another con of using bank financing is you have less monthly profit. I think that's pretty much obvious because you have to pay your mortgage every month, and you have to pay interest on top of that. So less money is going into your pocket every month. I just talked about interest rate fluctuations that can affect your cash flow and your profit. And then also just generally can reduce the profitability of your flips because you got to pay the bank back when they do the paperwork up front to get the loan. Also, you got to pay them much monthly interest. But if you ask me, unless you have millions of dollars sitting around or $1 million sitting around, I would suggest that it's in your strategic best interest to build relationships with banks so that you can get mortgages on properties when you find real estate. Because even if you have the money to pay it off, you always have that option to pay it off whenever you want, even when you get the mortgage, right? But you don't always have the opportunity to get a good mortgage on a property if you've already paid it off. You might be able to get a home equity line. You might be able to get a mortgage on it. That's pretty standard. But there have been times in the past where banks, especially big banks, were simply not doing any mortgages at all. Like I remember I went to my bank, one of the biggest banks in the world, JP Morgan Chase, and I asked them about getting a mortgage, and they said, "Sorry, we're not doing that right now." This was right around 2011 or 12. So, all right, those are the pros and cons of using cash versus financing. Hopefully, this was helpful. Make sure you ask me questions and wake up. We got a lot more to learn.